All right, folks. Is everybody in the mood to get started? Because the panel is. I am Matt McLaughlin, and I am the partner in charge of the New York office of Venable, and it's my charge tonight to welcome all of you here. We've got an extremely large crowd. We added our man on the spot, Mario, added a set of seats in the back, and we just added another column on my left. So this is an overflow crowd. I am delighted. We are delighted to host as many players in the entertainment industry as are here tonight. It's an honor to be able to give some opening remarks. I've spoken to some of you over at the refreshment stand around the corner. These events tend to have the refreshment stand highly populated in the beginning at the end. And I encourage all of you to stay after the panel is done and continue to network and talk to one another, especially talk to our Venable lawyers. I've spoken to some of you already. There's business lawyers here. There's entertainment lawyers. There's managers, there's accountants, there's all sorts of folks here. One of my charges is to remind all of you that this is a CLE credit-worthy event, so you should sign in and sign out tonight. There's also CPE possibly available, so the accountants in the room should also pick up your pens and sign in and sign out as well. Welcome to Venable. We are 118 years old this year. Can you believe that?
I'm not that.
It's a whole. You look great, buddy. You look great. It's an ancient, reputable firm. But for all of the hoary, sort of stoic elegance of old Venable, we remain a cutting-edge firm. We are always at the cutting edge of all of the practice groups that the firm supports. Privacy, data security that might pertain to some of the folks in this room. We've got a budding, blossoming corporate M&A transactional practice firm-wide, and particularly in New York, that's growing. The tax and wealth planning group, some of the crown jewels of that group are here tonight, and we're going to talk about them in a bit. Whatever the field is at Venable, we've got some of the best practitioners in the country, and we also have a lot of the thought leaders in the country, and I'm standing to the immediate right of three of the preeminent thought leaders in the tax and wealth planning industry and field. And I know that the crowd is as big as it is tonight because you know that as well. Nationwide, we are just shy of 700 lawyers, and these lawyers are spread across 8 offices. Obviously, you're in one of those 8 offices, and we could argue about it, Alan and Shane, but I think you're in the best office. The New York office has about 100 lawyers in it, and it's growing very quickly. We are proud to host as many clients as are here tonight. And for those of you who are not clients, I hope by the end of the night, you rapidly make yourself clients. And when you hear this panel, I think you will know that these are the folks who will help you make sense of the tsunami of tax law legislation that's come down in the last couple of months, particularly affecting the industry that brings most of you here tonight. This panel is expected to be good enough that they are being recorded. So your remarks, your questions, your observations, and their dissertation is also recorded. I'll make a very quick round of introductions before the panel takes it away from me. Alan Epstein, to my immediate left, is a giant of the firm, a giant in the firm, a titan in many, many ways. He's a leader. He's a practice group leader. He's one of the preeminent practitioners in the firm, and especially in this industry. For that reason, he wears a couple of titles around here. He's the chair of the Media and Entertainment Practice Group, firm-wide. He's also the chair of the West Coast Business Transactions Group. How'd you get 2 chairs?
I have a good lawyer.
And we also have the younger generation, the real thought leaders, the emerging leaders in the firm, the emerging leaders in the practice.
The guys that do all the work.
The guys who do the work for Epstein, and the folks who will answer the questions that undoubtedly you're going to have, and your clients are going to have, and all the folks in your industry are going to have, as everyone tries to untangle this new knot of the recent tax legislative change. So without further remarks from the partner in charge of the office, I just want to say it's an honor to be here with you tonight. We are overwhelmed by the size of the crowd, and we are proud of that crowd. And I'm very proud to hand you over to the panel. Thank you.
Thanks, Matt.
Thank you, sir.
Appreciate it. Hi, everybody. Thanks for coming out tonight. It's the first time we've done a panel like this in New York. We did the same panel to several different constituencies in L.A., and it was such a big hit. I guess we've decided to take it on the road. We know many of you in the crowd, but there are a number of faces that we probably can't connect to the name that we know. We know the name, but not the face. So please come and introduce yourselves afterwards and say hello. We also want to welcome tonight. We have some special guests from the studios. Normally, these programs are focused on the business management community and the CPAs in the industry, but we have some studio representatives here tonight. I'm not going to call you out, but I'm really glad you're here because we're all trying to figure out these things together. And while many of these issues are not of direct relevance to the studios, it helps the studios to understand why we do what we do because we often need to cooperate with them in terms of setting up our planning opportunities. So thanks to all you guys for coming. I think the idea tonight is we have 90 minutes to walk through some of the key elements. My daughter Eden is here. Hi, Edie. You can sit up front. Yes, you can. Come sit right. Yes, you can. This is Edie's turn to figure out what her dad really does. Hello. So we have 90 minutes, and we have a bunch of prepared material that we're gonna go through with you, but we want this to be interactive. So please raise your hand, ask a question, and let's have this be a conversation rather than a lecture. Mr. Blackman just told me before we started that there was an article that came out recently in Bloomberg that I had not seen, but I get the gist of it, which was, isn't it shocking that the entertainment industry, which is filled with so many liberals, got so many great tax benefits out of this new bill, and Trump and the Republicans really took care of the entertainment industry. Isn't that ironic? Ha ha. Well, as I think by the end of this conversation, you're probably going to come to the conclusion that that's a bunch of hooey. There are some things that are helpful to the industry, but overall, when you look at it in the aggregate, setting aside the studios, I think it's fair to say that talent has come out on the wrong side of the ledger, as have other important constituencies in the industry. So we are not kicking our heels with joy. We're doing the best we can to take advantage of what remains for us, but overall, it hasn't been a great outcome. So again, we're gonna work through the outline. Is one of you guys gonna run this? Okay. So you should have materials in front of you. If not, raise your hand and we'll get you copies. We also have printed a number of articles that we've written over the past couple of years from our group, including on topics like how do you plan for taking advances under 409A. The 409A issues are very tricky in terms of planning for advances. So there's an international tax planning article. There's a third article? Yeah, there's a 409A. There's a general tax planning excerpts from a chapter in a book that has a lot of commentary on the new tax law, an international tax summary, and also an ABA quarterly article about the new cost recovery rules. So I believe there's copies in the back for you. We're also going to email all of you guys PDFs of the material so you can share them with your family or colleagues. Okay, so we're going to start with the QBI deduction, which is on page 4. And Michael Bloom is in our New York office, and Shane is in the LA office. You want to run us through?
Sure. Yeah. You can just jump right into it. So the QBI deduction, which we'll get into, presents some planning opportunities for talent. But before we can get into the more interesting structural issues, I think it's important because we have a very mixed background of accountants, lawyers, business managers, actors, to give a little background about how the rule works. So I apologize if this is dry for some of you that already know it, but this will be the first phase before we get into the more interesting stuff. So the QBI deduction is a new deduction that was added into the code in connection with tax reform, and it is basically a deduction equal to 20% of a person's, quote, qualified business income, which is income, ordinary income received through a pass-through entity, meaning an LLC, an S-corp, a partnership, or through no entity at all, just a sole proprietorship. Generally, just a quick rule of thumb, the deduction equals 20% of the amount of qualified business income. There's some limitations that we'll get to, but just kind of as a rough estimate, think about it as 20% of a person's QBI. And again, this deduction only applies to individuals. It's not corporations. So generally, this is a talent side issue.
Well, it could be an S corporation flow through, but not C
right.
corporations.
Income that ultimately hits talent. So it could come through a corporation like an S corporation, but it would be taxable income to an individual. And the effect of the deduction is that it reduces the tax rate on qualifying business income from the highest regular rate for individuals, which is now 37%. But if this deduction applies, it would reduce that about 7 or 8 percentage points to 29.6%. So that's the benefit of the deduction. Now, as I mentioned briefly, the deduction doesn't apply to all income. It doesn't apply to W-2 wages. If you're an employee and you get a W-2, that's not qualifying business income. Guaranteed payments. So let's say you're a partner or a member of a pass-through entity, but some of your compensation is a guaranteed payment. I'm not sure if everyone knows what a guaranteed payment is, but say you're a law firm partner and you get, a salary of a fixed amount of $100,000 a year, and then profits of 10% of whatever the firm makes. Well, that $100,000 fixed amount is a guaranteed payment and doesn't qualify for QBI. But if you get paid on your 10% interest in the firm at large, that piece would qualify for the deduction. Now, as I mentioned, the general rule of thumb is the deduction is 20% of QBI, but there are certain caps that apply. There is a wage limitation that gets phased in. So generally, if you're above a certain income threshold, the deduction is limited to the greater of two formulas: 50% of the W-2 wages that are paid by the pass-through, again, incentivizing the small business to go out and hire folks that would receive W-2s, or an alternative formula, 25% of W-2 wages plus 2.5% of the unadjusted basis of qualified property. That means tangible, depreciable property used in the trade or business. That rule is going to be most beneficial for real estate. That was why it was added sort of at the last minute in conference. But for a lot of the businesses that we deal with in the entertainment space, they're not going to be capital intensive. They're sort of service and IP intangible property intensive. So oftentimes the focus is going to be on maximizing that first test, the 50% of W-2 wages.
And just to note as well, even though, like Mike mentioned, the unadjusted basis of all the qualified property, for that particular test is probably not going to apply mostly in the entertainment industry. But to the extent you have clients that have real estate businesses, it's important to know that 2.5% is effectively on the cost basis of your real estate. So even if it's been being depreciated over time, you still get 2.5% of the full cost basis. But once it's completely depreciated, you no longer take that into account.
We are seeing for independent producers ownership of copyrights, which is requiring them to capitalize cost. And we're seeing more and more talent now who historically would have been work-for-hire service providers becoming owners of their own content. So the basis rules, will kick in more in the future as those type of activities continue.
Good. Now getting to the more definitional issues of QBI. So it has to be income from a qualifying trade or business. So what's a qual? You're probably going to get asked by your clients, like, I'm doing this thing. Is this a qualifying trade or business? I have this loan out. I have this, side project. I have this endorsement deal. Is any of this a qualified trade or business? Well, let's work through the definition a little bit. A qualifying trade or business, it's defined in the negative. So it's any trade or business other than two things: the trade or business of being an employee. So if you're an employee with respect to those activities, the income earned would not qualify for this deduction. And it also doesn't apply, well, generally doesn't apply, but there's some exceptions, to certain service businesses, what they call specified service trade or businesses that get kicked out as basically having unfavorable status under the code. And these are sort of what you would expect: your doctors, your lawyers, accountants. But we've highlighted and read the categories that are going to be most relevant for this group. That's your performing artists, athletics, or any trade or business where the principal asset is the reputation or skill of one or more employees or owners. So in front of the camera talent, that's performing artists. and behind the camera talent, your producers, your directors, your writers, well, if they're engaged directly, they're getting W-2 wages, that's not going to qualify. But oftentimes they have a loan out, and they're paid through their loan out. But, the income that is earned by the loan out, what is the nature of that income? Isn't it not for the skill or reputation of the owner who's really providing his services through the loan out corporation? So, yes, the loan out, your traditional loan out example of the behind the camera talent is going to get captured by this sort of catch-all exception of basically an entity through which an individual provides his regular services. So this is basically, talking about that article on how the QBI is a big boon for entertainment talent. It's really not, because most of the folks that we deal with are going to be kicked out in these different categories.
Notice how engineers were not listed.
Yeah.
Right? There was a lot of lobbying going on. Engineers were not listed in the specified service.
Or architects, and I think the reason for that, most likely, I haven't read this anywhere, but this rule was intended to apply to real estate and real estate manufacturing. So to me, it makes sense that they would have carved out engineering, because that would be like the manufacturing industry. Architects are going to be in the real estate industry. So I think that's probably why those two areas were carved out.
So correct. So we understand the specified service business, and performing artists, athletes, behind the camera, they all fall into that category. Explain to us how, because it seems really exciting, but when you actually pierce through how the limitations work, there's not a lot of opportunity for most of these folks.
Right, and the easiest way to see that is to look at the top right box. So that's specified service businesses that are over this threshold. The joint filers making $415. Or single filing making $207,000 a year. No deduction permitted. And often for a lot of our client base, that's going to be the case. So all the talent, all the athletes, artists and directors, what have you, that are, over those thresholds, no deduction permitted. That said, if you kind of move your eyes to the left and you look, okay, well, what if I'm below those thresholds? And I'm in those sort of unfavorable types of activities, well, you can still benefit from this provision, up until a point in which case the phase-out kicks in.
We have a question?
Yeah.
Before you get the QBI, you cracked out reasonable compensation. If you're an actress, make less than $400,000, file a joint return. What's the reasonable compensation?
Let me try. So because we're being recorded, we're going to repeat all questions. The question was, if you are a loan out and you're furnishing the service of an actress, like my daughter Eden, for example, she's so embarrassed right now. And by the way, this is relevant for you, honey. I'm just saying, the loan out has to pay reasonable compensation for the services of the talent. And whatever you pay out as comp is not going to be eligible for the QBI deduction. It's only what remains after the compensation is paid. And there's a wide range of views on what level of comp you need to pay out of a loan out generally, independent of this issue. So we have seen a number of audits by the IRS where they're taking the position, I don't know if they're doing it in the East Coast, but on the West Coast, they're taking the position for an S-Corp loan out company that has no other assets other than is being a pure personal service company, that 100% of the profits need to be paid out as compensation, and anything less is unreasonable. Now, we don't agree with that at all, but we also agree that it should be more than zero. And our comfort zone is somewhere in the range of 25 to 33%. You can push out as an S-Corp dividend. At higher income levels, maybe you can do a little bit more, and maybe even at lower income levels. But there has to be some comp paid. So the point you're making is that you can't take it all the way to the limits, because you're going to have to pay out comp regardless. And guys, the total taxable income threshold here that we're talking about on this chart, this is after the payment of compensation.
Includes all income.
Includes all income.
You look at your total
portion, the flow-through portion.
You look at your total taxable income, and if you are a specified service business that would normally get kicked out, then effectively what happens is up until the threshold, you can take the full 20% on any pass-through income. Once you hit the threshold, then for example, on if you're married, you can take 20% if your taxable income is below 315, and then from 315 to 415 on the next 100, that 20% benefit effectively gets phased out. And then the way the rule then works for if you're not a specified business, if you're under that 315, you get the full 20%, and instead of having the 20% phase out, from 315 to 415, the W-2 wage limit then gets phased in, and then once you hit 415, if you're not a specified business, then you still get the benefit, but it's subject to the W-2 wage limit. And I just want to add to Alan's comment about the IRS challenging S corps and saying that you got to pay out 100%. We did some work on a production company client where we had to analyze the rules with regard to what actually needs to get paid out versus what can flow through. And I'm pretty sure I've read every ruling and case from 1974 to 2012, and every single one of them were all egregious scenarios where 0% was being paid out as comp, everything was flowing through. The reason I mentioned 1974 is because there's a ruling from 74 which was that fact pattern and egregious scenario, and in I think 2012 or 13 when the IRS started issuing their S corp acceptance letters, they cite to that ruling and say, oh, don't forget about this ruling. The reason I said 2012 is because there's a case called Watson versus U.S. I believe, and the relevance of that ruling to that analysis is that there's 4 S corps that own a partnership that was an accounting firm. They allocated the income from the partnership to the S corps. One of the guys talked to his partners and asked them, what should I pay myself out as comp? They said they all agreed that $24,000 is reasonable. His total income in his S corp was 120, and the importance of that case is that when the IRS was challenging that his position of whether or not 24% was unreasonably low, they focus on the employment tax rules that focus on is this remuneration for services, and in that particular case, he had 120 of total. The IRS brought an expert in, they analyzed what would be reasonable, and they determined that 90,000 would be reasonable. So what that says to me is that no, there's not a blanket rule that 100% has to get paid out, and the fact that if you make under 315,000 that you could be eligible for a 20% deduction on your pass-through income also bolsters that just can't be the rule, or else they wouldn't have included this in the legislation.
Or whether the government will issue some sort of safe harbor saying
we don't have any knowledge that there's going to be a safe harbor published in the regulations. I will point out, before I take your question, Andrew, that there have been many attempts by Congress to codify the requirement that compensation be paid, and if you fail to pay it, the IRS would have the ability to recharacterize an S corp dividend as comp, and they fail every time. So for the IRS to take the position that 100% has to be paid out when every legislative effort to mandate that has failed shows that couldn't be the law. Otherwise, there would have been no need for all these legislative efforts. So these audits are working their way through. We hope to settle them and make them go away, but they're being really aggressive on this right now. Andrew with the question.
My takeaway from this, before I heard this, was the average client who can afford a business manager is not going to see any of this 1% reduction because they're going to be making too much money and they're going to be over the income.
For pure loanouts, that's true, and then we'll get in later in terms of we've been looking at what types of clients and what types of businesses potentially might qualify, and we'll go into a little more detail there.
My daughter, on your right, will benefit from this. Hopefully not for long. She's an actress, and she's going to fit into these rules. Watch her new series, Sweet Bitter, on Sunday nights on Stars.
Proud father.
Sweet Bitter. She's a series regular. I'm very proud of her. She's blushing very brightly right now.
So before we get into this, the meaning of...
Our business manager's not here, but maybe we need to change that.
So before we get into reputation or skill, it actually didn't click with me until Alan mentioned at the intro. A couple weeks ago, I got asked if I would be interested in being interviewed for a Bloomberg article. And so I got approval from Alan and Michelle, and I was interviewed, and then I got an email saying, "Hey, we wanted to thank you for your for taking the time with us. Unfortunately, my editor ended up editing out your quotes." Okay. So now that Alan's mentioning about the pro Hollywood, it could be that my comments maybe weren't so pro, or maybe kind of neutral.
Oh my God, that's fake news. Okay, let's keep going.
Okay, so the big question that everyone asks, and I'll kind of go through. The first question, obviously, is do we qualify? And in the entertainment world, the answer on first blush might be no, because they're specifically calling out performing artists. And if you've got a pure loan-out company and you're behind the camera, you're going to generally be picked up in the reputation or skill category. But there's that particular, the definition of specified services is defined by cross-reference to the qualified small business stock rules. And what that means is, even though this is new legislation, that there's some authority under those other rules that gives some guidance as to what does reputation or skill mean. Unfortunately,
and again, right now we're focusing only on the catch-all provision, which includes in specified services,
right,
reputation and skill.
Because the goal here would be that if you're not one of the enumerated specified services, you want to get out of the reputation or skill category so that you can get the benefit of the deduction. And so under those the qualified small business stock rules, there aren't any regulations, so there's no guidance there. There's very sparse legislative history, so there's no guidance there. But there's a 2014 private letter ruling, which basically gives some guidance as to what reputation or skill means. And it focuses on what value is provided to the customer, and it gives an example of, it basically says that if the value providing to the customer is services, and it gives the example of providing hotel rooms, or if it is individual expertise, and it gives the example of law firms, that's going to be the principal asset of your business is going to be the reputation or skill of one or more employees or owners, and you're going to fall within that catch-all, and you're going to have to navigate the rules, and you might not be eligible if you're over the income threshold. The importance of the ruling is generally that the facts of the ruling, there's a pharmaceutical business that, although it's in the healthcare industry, and healthcare services is one of the enumerated services on the list, the ruling basically says that even though the pharmaceutical company is in the healthcare industry and it has a reputation in the industry, that the value that it's providing to its customers is manufactured assets and intellectual property, i.e. the drugs that it's developing and delivering to the customers. So the reason why that's important is that, as we mentioned, I think going on to the next slide, front of the camera, loanouts, pure loanouts, behind the camera, pure loanouts, not going to qualify, because that's purely the value that you're providing to the studio is your acting services, your production services, your directing services. Where it becomes a little more interesting is with respect to production companies, because I look at there being like a spectrum with respect to production companies. If you're pure work for hire, the owner of the IP at the outset is going to be the studio, and all you're providing in that circumstance is services to the studio, which in my mind you're not going to qualify, because what you're providing is services. That's the value that you're providing. Compare that on the opposite end of the spectrum, which is your production company that develops your own IP and your own content, and you're exploiting that content and licensing it out. Now you start to look more like, in the context of that ruling, that the value you're providing is the content that you developed, and then you therefore then may be eligible for the deduction. And then somewhere in the middle that I think is kind of a gray area is in the context of negative pickups, where effectively the studio is giving you instructions in terms of what content they want you to deliver, and you create the content, you own the content at the outset, and then you deliver the final product. So you're effectively selling them inventory. So that's a gray area, because you get the same end result as a work for hire, but because it was structured a little differently, you might be able to argue that what you're providing is the end content.
Yeah, I do think there's an opportunity for negative pickups, because you're selling an asset. You're not just providing services, and during that interim period, you are the owner of that asset. So that's interesting. And then with respect to the spectrum that Shane outlined, I don't know what you guys are seeing, but on the West Coast, we are involved with so many what I'm going to call co-fi deals, where we represent, say, a television producer or a movie producer, and they are going out and raising capital and forming their own independent studio. So oftentimes with a real studio at their side. Sometimes it's an investor from China. There's capital flowing in from all over the world, and those companies are, I think, clear candidates for the QBI deduction if you set it up properly. So in the old days, maybe 10 years ago, we would have had very few clients that could have kind of worked their way into this category. But with the changing modes of distribution and ease of raising capital in today's environment, where you can go straight to the consumer, we're seeing more and more of this. Now, the one thing I want to say that overrides all of this is that we don't have regulations yet interpreting these rules. So all we are able to do at this stage is give you our views based on the statute and the legislative history, which is meager. So
on that point, Treasury announced that they're expecting guidance on the QBI various issues at the end of the summer. And in a white paper that was published by the AICPA on its proposed guidance under 199A on this specific issue, they proposed a definition of a specified service business, or as the principal asset being the skill or reputation of the owner or the employee, as being determined based on whether customers, patients, or clients look to specific individuals to perform the required tasks. And the support for that position, the AICPA pointed to the PLR that Shane cited. So again, sort of looking to, well, what's the value that the customer, the consumer is getting? Are they getting someone's services, or are they getting a product, even if that product might be endorsed or branded with such a very strong, powerful brand? At the end of the day, they're still getting a product or a good. So the business that's providing that should still qualify. Again, that's proposed interpretation. We'll see what happens at the end of the summer, but it's possible that it goes in that direction.
Where it gets a little troubling is any time there's a key person designation in a talent agreement, which says, I, Eden Epstein, am required to furnish the services pursuant to this contract. It's not an assignable commitment, and that could apply to a producer as well. That starts to look very much like you fall into the specified service category. And you're going to see that in all of these deals. The interesting thing is going to be is that, does the consumer who's watching the movie give a hoot who the producer is? If it's J.J. Abrams, maybe, but it's mostly like, it's just the product. I want to watch this movie. I heard the movie's good. So until the regs come out, it's going to be really hard for us to plan. In fact, we've been approached by a lot of clients, and we have conversations like this, and we just basically say, sit tight until the regs come out, because it doesn't make sense to turn the world upside down right now until we know more. Andrew?
How do you think the talent agent whose name is on the board is responsible for the revenue person firm is a key person fits when it comes to reputation and skill?
Okay, so the question was asked how a talent agency with a 50% owner or whatever doesn't.
100% owner, but 50% of the revenue of the company.
Yeah, so a very substantial talent agent who owns the company and is responsible for a lot of the revenues. How would that talent agent fit under this definition? And that really, I think, question really lines up with the final bullet where we're talking about management companies, because management companies, as you guys know, are a hybrid of commission businesses where they're providing services just like a talent agent, and they also have a production component to them, which the talent agencies cannot do. So maybe we can just analyze those together with respect to that aspect of the business, and then we can layer on the producer piece. So it's tricky. We've been asked this question, and the reason I think it's tricky, and you guys may differ, we haven't talked about this in a few weeks, but I think it's tricky because in a talent agency you have what I'm going to call a double key person business. You got a key person, hotshot agent Joe, who's the agent for key person client, who's hotshot agent client. And so you got two levels of services being tied to skill or reputation. And maybe you can argue that there's so much institutional goodwill in the name of that talent agency that it's bigger than the services of the agent, and the profits of the agency are generated not just by his or her services, but by the institution as a whole. So I think you have, on the spectrum, an easier time if it's CAA, WME, certainly WME, given the diversified nature of their businesses, than you would if it was a smaller agency like the Gersh agency, which is identified with the partner's name. It's David and Robert Gersh. And
Talking more about that.
yeah, so in the smaller agencies where it's really tied into the person, I personally think that's a hard case to make, but I'd be curious to know what anyone else here thinks.
Yeah, I've heard the argument that until there's guidance that you could potentially look to the personal holding company rules and argue that if there's not a specific individual named as a key man, that you could try to take the deduction. But based on the ruling and the fact that you look at what value is being provided to the customer, in that case, an agency is providing services. And so I feel like there may be arguments that you can make, but I think that, it's a gray area. And with what Alan mentioned with respect to management companies where you have a mix, I think you have a better shot at trying to get the deduction, but there isn't guidance yet in terms of if you have a mixed business that has both services and something else. The statute says the principal asset, and there's a lot of areas of the tax code that is worded as in, like for tax avoidance, the tax avoidance purpose or a tax avoidance purpose, and there's a distinction in different areas. So in my mind, when I read the statute and it says the principal asset, that suggests to me that the IRS likely will come out with some sort of test to determine if you've got a mix of different types of assets. Is the principal asset services, or is it some sort of product that you're providing to the customer?
And for agencies, I'm sure you guys have seen agency papers or contracts over the years. When they're signed, there will almost always be a key agent designated as the key person. So that falls right into the trap that will likely make those difficult circumstances. But again, TBD. Once the regs come out, we can evaluate it further.
Yeah, and just building on to the key man concept and going back to production companies, once we've identified that, hey, there might be this spectrum where if you own content, you might be able to qualify, then the other questions that we then get are, well, I have a producer that, and this is a fact pattern that we got recently in the last couple months, I have a producer that was a creator of a TV show. The studio owns the IP, but by the way, there's no key man clause, so if he were to pass away, he continues to get 20% of the income. So what we're thinking about in terms of a potential structuring opportunity, because the questions are going to be, once you think you qualify, can you structure into an ownership structure in order to get some pass-through income? And the second is, once you've structured into an ownership structure, can you then generate W-2 wages to maximize the deduction? So the first fact pattern regarding ownership, in our case, we had a pure loan-out corporation effectively, but given the facts where there's no key man clause, what we're thinking about considering is approaching the studio at the time when the next season becomes renegotiated, and try to get them to contribute the content into an LLC and then issue a profits interest to the producer, such that now he has an ownership interest, and so on any pass-through income, because the value is related to the content that's being exploited. Now we've just structured into an ownership structure to potentially qualify for the QBI deduction.
We have 3 projects like this right now. Newly formed independent production companies where there's the key producing partner who gets 25 to 50% of all fees and back end. And the business deal is we're going to pay you a service fee. But like Shane is saying, if we can actually bring that person in as a profits interest member of the LLC and start paying out their profits as a distributive share versus as a W-2 comp, and assuming the LLC actually owns IP under a co-fi or other arrangement, it's kind of interesting. So it's always hard to get the principals to agree to make that person a real partner because they don't really want to do it. But we're all going to be under a lot of pressure to do this. And I think once the regs come out, there's going to be a lot of work to sort through. Right now we're just thinking and preparing, but more to follow. We can probably pass the band discussion. And
yeah, just really quick before we move on, I just wanted to note too, once you have the ownership structure, then there's the W-2 wage issue. So a couple years ago, there was 2 individuals that we negotiated with for them to get profits interest in an LLC with the studio that owns the content. So they already have ownership, but which is common in production context where the W-2 wages are outside of the LLC entity. So in that case, the studio is running all the payroll, In the statute, it's the W-2 wages, it's defined with respect to the trade or business. So there might be arguments that the W-2 wages that are being paid by the member of the LLC that's the studio are attributable to the business under an agency theory, but one of the issues then is we don't know for sure if that is going to be an argument that would hold up. So one of the things that might be considered is having our client drop his profits interest into an S-Corp in order to generate W-2 wages from his S-Corp and take it at that level, with the caveat that the statute leaves open for the IRS to issue guidance on tiered structures. So we're not sure if that would if that's going to fly, because we're still pending additional guidance.
So last thing I just want to mention before we move on is the first point about structuring, which we've been alluding to, is going to get really interesting for what I'm going to call the gorilla client. These are the monster talent clients. I know, Arnie, you've got one of them. We have a bunch of them. These are the very successful, the most successful producers and directors who have studio-like attributes. They may be under an overall deal with the studio for motion pictures or TV, but all of them are starting to do stuff. They may be launching a video game division. They may be launching a licensing division. They may own tons of IP, even though they're work for hire. They may have IP portfolios. And historically, when we've planned for clients like that, we always try to separate those businesses into different silos for liability reasons. We don't want loan out income getting infected by business income and so forth. But once these new rules come out, we are likely going to consider unraveling the silos and merging a lot of these activities together so that we can qualify for whatever the principle, however principle is defined in the regulations. That's what we want to make sure that we do not satisfy. So we're trying to get out of having the principal asset being reputation and skill, because we've got all this other stuff. So stay tuned.
And you also might have wages concentrated in one entity, not many wages in another that then you can't use to get the full benefit of QBI. So if you could aggregate or unwind, it would be helpful to maximize the deduction. It's very similar to what's going on in real estate, where you have a single management company and then a bunch of different silos that actually own the assets or generate the income that are owned by sort of the family or the principals. And so there's a lot of lobbying or pressure from the real estate industry to allow that type of aggregation that might be useful in the entertainment context.
Real estate was the biggest winner in this tax bill. And I can't remember, what business is the president in? And, we actually got approached to help some mortgage funds. These are funds that hold mortgages. They just buy them and hold them. And big ones, tens of millions of dollars. And they are all considering becoming REITs. Because a REIT qualifies for the 20% pass-through, a non-public fund would not. So again, tax-motivating strange behavior is not good policy, but that's where we are.
Yep.
Okay, let's keep going.
Shifting now to loanouts and drafting employment agreements, there's going to be what we think a renewed emphasis or demand amongst talent at all levels to at least inquire about maybe using a loan out for two reasons primarily. The first is at the lower levels, there is still the ability to get the QBI deduction, up to that $315,000 limit, in which case it phases in, and then up to, from there, another $100,000. So, folks at the lower end of the spectrum could still benefit from restructuring their operations into a loan out to take advantage of the QBI deduction.
Yeah, and just to chime in real quick, film and TV studios generally are going to treat people as employees regardless of whether or not they would be treated as an employee under the tax rules, which means a writer, for example, that might work for multiple studios during the year, under the tax rules might be an independent contractor. The studio might treat them as an employee. So under prior law, where the cost of forming a loan out and maintaining it may not have been beneficial because you're weighing how much is it going to cost versus how much I'm making. Now that the new tax law has repealed miscellaneous itemized deductions for employees, now the analysis is different because you got to take into account that if you're an employee, you can't deduct anything, but if you form a loan out company, you can deduct it. And for writers where just as a standard practice, you might be treated as an employee when you're really not, it might now make sense to have a loan out company.
Yeah. There are also, even outside of the entertainment
Hang on one sec,
context.
Michael, one sec. So has anybody run the numbers to see what the break-even point is at the low levels of income? Because I know it's come down. The answer is it depends on whether the business manager's percentage or hourly. But, in the old days, pre this act.
And also how many other percentages.
Yeah, it does depend on the overall level of professional fees for sure. But what I observed in practice was a break-even point of somewhere between, say, 200 and maybe 175 to 250, depending on the level of expenses. Does that sound consistent with? Yeah. Now, with employee business expenses being non-deductible, and we all know, yeah, I mean, it could make sense at 100, and that's going to mean more loanouts for you guys to the extent you're taking on baby clients. Yeah.
Even partners in accounting firms and law firms are looking at this and saying, well, hey, now I've lost this benefit, and maybe I'm low enough to take advantage of the QBI deduction. Maybe I should form a loan out. And so we're even getting approached by the folks that represent talent, i.e., folks like yourselves, to consider this issue on their own behalf. So it has widespread implications.
The executive loan out area is one that's super hot right now. So let's have a discussion about that. So typical case is, the head of a small production company who's participating in the producer fees and back end is an employee, has sort of historically been treated as an employee. And some of these folks have percentage professionals. Even though you might think of them as employees, what executive would do that? Well, in showbiz, they need relationships to further their career. So they might have an entertainment lawyer. Some of them even have agents or managers. And the non-deductibility of their professional costs as employees is a massive cost to them. So when I'm representing the company, I'm getting some very hot calls asking to figure out a way to restructure these relationships. And when I'm representing the executive, I'm begging for mercy from the company to give us some relief. And we had a situation where the head of a music label, this is a guy that made over $10 million a year, had been a W-2 employee, and he had a 20% expense load. So you can imagine the after-tax impact. So, we're in the process of approaching the music label and trying to get them to drop some assets into a subsidiary LLC and to bring our guy in as a profits interest holder, profits interest member of the LLC, and then trying to replicate his economic deal into the LLC operating agreement and then have him treated under the guaranteed payment rules. So Michael mentioned the guaranteed payment rules in the beginning. If you are receiving guaranteed payments from a tax partnership, that's not employment income. That's not W-2 wages, and you have the ability to deduct those expenses if you can fit yourself into that category. And the same issue comes up a lot in all different types of companies where historically, if you had an LLC that had a profits interest pool that was going out to a group of people, key executives, and they would often set up what we call an upstairs-downstairs structure, where the upstairs company would be a holdco for the entire management team. So the management team would not hold their interest directly in the LLC. They would hold it in a holdco up top, and that holdco would be managed by the principals. So one of the so-called advantages of that structure historically was that it gave those executives the ability to continue to be treated as an employee because they no longer worked for the entity. They were an owner of an entity that was different than the entity to which they perform services. And the old IRS rule, which says that an employee can never be a partner of a tax partnership in which they're a partner, that doesn't apply. So that's the historical genesis of these upstairs-downstairs structures. Now they don't make sense anymore because those executives, to the extent they have unreimbursed business expenses, can't deduct them. And so if you are seeing upstairs-downstairs structures, a lot of the corporate lawyers have not caught up with this yet, this dynamic. So if you have a client who cares about this issue, challenge that structure and see if you can shake them off it and have them come in as a direct member. Then they're going to be eligible to deduct their business expenses. Okay. Can we rip through the next couple of charts here? Because I think Michael, you want?
We can breeze through this pretty quickly. What we wanted to show here is that there's been some questions raised of, well, okay, now that the C Corp rate has been slashed to 21%, do I really need to futz with all of the complexity associated with creating an LLC and tax distributions? Isn't the C Corp rate essentially now on par with operating through pass-through form? And the answer is generally not. Depending, it's facts and circumstances. So I don't want to say there's one answer and you should always do this. But as a general rule of thumb, if there's an operating business that's going to be earning profits and distributing cash out, it still makes sense to operate in pass-through form because of the double tax incumbent with a C corporation. But
you mentioned the key assumption, which is a business that's paying out or distributing profits.
Exactly.
Explain that.
And so, all right, so you have, let's say, two scenarios. One, you have an operating cash cow business, and it's paying out earnings consistently. Well, in that sense, you want to avoid the double tax. It's more efficient, regardless of whether or not QBI applies, to operate in an LLC or pass-through structure. That's the general rule of thumb, and that's what this slide is intended to show. But oftentimes you'll also see, C Corps, which are, well, what if we don't have a cash cow in our hands? We have a startup business who's, maybe operating at a loss, or anything that it does make, it's going to plow back into the business. So, we don't have that second layer of tax. And our exit strategy is to, get acquired or IPO, and the market doesn't really seem to care about getting a basis step up on the acquisition, which they would get if it was an LLC or a flow-through structure. So, again, depending on the facts, that's why if it's kind of a cash operating business, you want to stay in flow-through form, but for those VC, startup-y, IPO investments or ventures, the C Corp structure may make sense. And that's why oftentimes in Silicon Valley and things like that, you'll see corps in that world. So again, when you have celebrities that are kind of dabbling in everything, you're not going to have one answer. You're going to have to look at, well, what exactly are you doing? And let's think about it a little bit.
I mean, the general rule is if you're stripping out earnings, a C Corp's not going to make sense, even though the 21% on its face might look enticing. And even if your play is you want to defer income, then you have to navigate the accumulated earnings tax and reinvest the earnings and all that. So there's other considerations to make, but the general rule of thumb is don't, jump into a C Corp because you see 21%.
We got so many calls after the tax bill was passed. Could I be a C Corp? And the other problem for loanouts, of course, is the question that was asked earlier. You have to pay out some level of reasonable compensation. And since you're paying out comp, you're not benefiting from the 21% rate. So don't be seduced by that.
And then just a few takeaways before we move on to cost recovery. The fact that there's now a bigger distinction between what deductions an employee can take versus if it's running through a company, that potentially might mean that the IRS might now scrutinize loanouts more. And under the case law with regard to loanout companies, you have to have, they'll generally be respected if the company has control over the employee shareholder, and also you follow corporate formalities. So a lot of times in the past, sometimes people are a little bit passive about, do I need an employment or do I not? Because it's really an agreement with myself. But the employment agreement is really important, especially now, given that the deductions have gone away for individuals effectively. And the reason why is because the employment agreement establishes control contractually over the employee. And the other thing is it adds in other additional corporate formalities to follow, such as compensation. Because a lot of times we get an agreement that we review and it just says the company at its discretion will pay out comp. Well, no one in this room would go work for someone that just would pay you comp at its own discretion. So in our agreements, we build in a formula, which the purpose of that is to show more of an arm's length compensation formula, but also establish an additional corporate formality that you can point to that you've been following to have your loan out respected. And another thing to point out as well, and this isn't related to the new law, but under the Copyright Act of 1976, that gave copyright creators the copyright termination right, where they can, even if they get rid of their copyright, they later in time can reclaim ownership or renegotiate the deal at a later time. That period is 35 years, which we've just passed recently, so we're getting more and more calls about claiming that right. And one of the important things is the employment agreement has to be drafted in a way where you're not somehow getting rid of your copyright termination right because you've created a work-for-hire relationship. And then really quick before we move on.
If I can just mention on that, there are so many different forms of employment agreements that are used for loan-out companies. These are really important documents, and oftentimes the loan-out agreements are prepared without a lot of thought towards tax or copyright issues. And we have prepared a very comprehensive agreement that integrates all this. So if you ever need help on employment agreements, they don't cost a lot because we've got the form done. But they're important to do properly. So if you're seeing a short form version, or in particular, the kind of agreement that says this, it says you, the talent, will be paid whatever level of compensation the board of directors determines is reasonable in a given year. Like, who would ever work under an employment agreement like that? That's completely hokey, right? And if the IRS were to come in and start questioning about reasonable comp, and are you really respecting the separateness and the corporate formalities? I think that's an easy one to punch through. So you need something more concrete that looks like an arm's length agreement between a corporation and its key service provider. And we can help you guys out with that. Okay, go on, Shane.
And just to note briefly, athletes really get dinged with the new tax law and the removal of miscellaneous itemized deductions, because most, if not all, of the major leagues treat the athletes as W-2 employees. So because of the repeal of the miscellaneous itemized deductions, athletes are now no longer going to be able to deduct their agent fees and other material fees. And also, so then I've gotten last year, just to give a quick example, we helped an athlete do some residency planning to break residency in California and go to Nevada. And so part of that planning was, checking all the boxes for residency, which included forming his endorsement entity in Nevada so that you're availing yourself of Nevada law that further bolsters that you're intending to leave California. What I found interesting is that the local council that set up the Nevada entity formed it as an LLC, and they did so because Nevada doesn't recognize S-corps. But my advice was still to continue or make a check-the-box election to treat it as an S-corp, because in my view, if you have an endorsement entity, the value of your endorsement business is directly attributable to your major league contract, so you should be able to allocate at least a portion to the endorsement entity and deduct those expenses at the endorsement entity level. If not, some people might be more aggressive and maybe you attribute all of the expense to the endorsement.
You're talking about the agent's fees on their player deal, running that through the endorsement?
Potentially, taking the position that you wouldn't really have your endorsement deal without your major league contract and allocating some of your expense to your endorsement deal.
It's only one entity.
I'm sorry, what's that?
The endorsements and the contract are all under
The player contracts can't be in the same entity, right? Because they have to be an employee under the collective bargaining rules.
So that's just an example of people. There's not a solid fix to it. That's just one example of a potential idea to try to bolster a deduction. And the other benefit to that in that context too is just having a separate entity, and if you are running expenses, having that reported on a separate return, so that when you have all your W-2 wages on your individual return, you don't have a bunch of other expenses on your individual return.
Do you see anything in terms of on-air talent in the media industry?
So the question was, have we seen anything involving on-air talent in the media industry? Most of the on-air talent, as you guys know, are W-2 employees. They can't use loanouts. So I haven't seen or been asked to figure out a way to crack that code, but I'm expecting that's going to continue to be a problem.
All right, so moving on, Mike's going to start going over cost recovery rules and production timing differences.
Yeah, so as most of you probably know, 181 after 2017 is no longer around. It was replaced with a bonus depreciation system. So basically, the qualified film production costs are now treated as an asset that's eligible for bonus depreciation under 168K. And this has, I would say, two very interesting implications. The first is under 181, the deduction was allowed when the cost was incurred. So you incur the cost to make the film before you release the film. So that means you get the deduction earlier. Now you have to wait until the film is placed in service. The film, television show, or live theatrical production is placed in service like any other bonus depreciated asset. The second piece that's interesting is that 181 was capped at expensing up to $15 million, or in some cases $20 million. Well, there's no cap under bonus depreciation. And so when you talk about boons to studios or potential, windfalls versus the talent side, one of the things that folks might point out is, well, hey, this could be a great benefit because now the cost to make a big budget film, $80 million or whatever it is now deductible in the same year, in 1 year. So.
So the three takeaways are, in terms of changes, are that the definition of what's a qualified film, both for Section 181 purposes and the new bonus depreciation rules, hasn't changed. You still look to see whether or not you have the requisite amount of compensation paid for services in the U.S., and if it's a qualified film or TV production, under the same rules that were under 181, you're also going to go through that same analysis to see whether or not you have qualified property for the new bonus depreciation rules. And as Mike mentioned, one of the key differences is the timing in which you can take that deduction. Under 181, you were able to, if it was a qualified U.S. film or TV production, you were able to deduct your expenses as and when incurred, whereas now you have to wait until it's placed in service, which is also the same requirement if you don't have a U.S. production. If you have a foreign production, you also add a place in service requirement, but you're then under the income forecast method, which you have to then recover your cost over a 10-year period based on your income forecast. So the other, one of the big requirements is the timing in which you get to take the deduction has changed. The other difference that Mike mentions is that the cap that before you could only deduct up to 15 million or 20 in certain low-income areas if the production's produced there, that's now gone. And another interesting change as well is that under the bonus depreciation rules, qualified property, which by definition includes qualified film and TV, now applies to acquired property, and it applies if the property was never used by the taxpayer and it was acquired in a taxable transaction from an unrelated person. Under the old 181 rules, you could take a 181 deduction with respect to acquired film or TV production if it hadn't previously been placed in service. The way that the rules are now drafted under the qualified property bonus depreciation rules is that it applies to, you're able to take bonus depreciation if the property was acquired after 2017, September 2017, and placed in service after that date. So we think that and this is now relevant when you think about bankruptcies like Weinstein, the Weinstein Company, is that they're going to be selling their assets in bankruptcy. So one distinction to keep in mind is that under the 197 rules, which require you to amortize certain acquired intangibles over a 15-year period, if you acquire a film or a copyright as part of an acquisition of a trade or business, it's a 197 intangible and you have to amortize it over 15 years. But there's an exception to that rule that if you're buying a film or a copyright individually, that it's not a 197 intangible, in which case it then may qualify potentially for bonus depreciation. So one important thing to keep in mind is that there's an interplay between the cost recovery rules, the deferral method election, which was prior law under Revenue Procedure 2004-34, which has now been codified in the new legislation, and also the NOL rules. And to give an example as to how that applies in the interplay there, is that especially with tech companies that are now getting into the content business, from my experience on like Google transactions, for example, Google generally does not want to own an interest in the company, which means the cash they put up isn't going to be treated as a tax-free capital contribution. And they also generally don't want to own the copyright, which means the production company owns the copyright and it's stuck capitalizing its costs. So when Google pays $5 million to the company in year one, that's effectively the deal generally would be, we're going to give you $5 million advance royalty in year one. When the project's completed, you're then going to license it back to us for a period of time. And the issue with that is if you receive $5 million in year one, that's an advance payment of a royalty. It's taxable income. And if it gets licensed back in year two and Google places it in service, you get a deduction in year two, which would create a $5 million loss. But under the new NOL rules, you no longer can carry back losses, so you can't rectify the timing difference. And also, if you then carry the loss forward, you're only able to use the loss to offset up to 80% of your income. So there's a big timing issue with the new rules.
Let me just frame, this is a really important point. So Shane's talking about, Google or YouTube financing a small piece of content, some kind of, short form content or the like. And we're seeing a lot of this. But it could also apply, something we see in the indie film world is where an independent producer will sell a piece of the waterfall to some third-party investor for $1 million, $2 million, $3 million bucks. They get an executive producer credit, and they're in the waterfall. And most of those deals are structured by the entertainment lawyers to not be contributions to an entity. They're just contractual rights. You guys have probably seen these. They're called investor agreements or investment agreements. That investor has no ownership interest in the copyright. They have no ownership interest in the company producing the film, and all they get is a contractual right to share in the waterfall. It's often supported by a collection account to give them some security. And that transaction, just like an advance from YouTube or Google or whomever, is also going to create taxable income as soon as you take that income in. You have to recognize the income, and if you don't place the asset in service in that year, you are hosed. And you got a timing difference that is really tough to manage, because in the old days, we could at least carry the NOL back from the following year to the prior year. That would solve that problem. And you want to mention, Shane, how because you brushed over the 2004-34, but just explain what this is and why this is, because this is a potential solution. If you get caught in this situation, what we usually try to do is, if we see it, is we will fight hard to make sure that investment money comes in as a capital contribution. So we would say, Mr. Investor, you're not going to get a contractual right. We're going to actually bring you in as a member of the LLC. And then it's a tax-free capital contribution. We don't have this problem. But if we can't fix that, then tell us about what we can do, Shane.
Yeah, so prior to the new act, Revenue Procedure 2004-34 allowed you to, if you're an accrual method taxpayer and you get an advance payment of enumerated types of payments, which include advance payments for services
and royalties,
that you can defer that income for up to 1 year to the next taxable year. And so this was a technique that was used under prior law, and under the new law, it's partially been codified in the statute, and the IRS recently issued a notice that says that you can continue to rely on 2004-34, which is important because the way that the rules operate, you need to also look at 2004 that revenue procedures to make sure that everything works properly. But the concept is basically that if you have the production company elect accrual, then you can defer that $5 million that you got from Google until the next taxable year. And if Google places if the content's placed in service that next year, then you get to take the deduction, 100% bonus depreciation, and line up your income and expense. So this is a technique that was used prior to the new law, but it's now even more important with the new law because of the loss limitation rules.
But you do have to go accrual method, and you also have to make certain elections. You can't just kind of fix this after the fact. You have to anticipate this up front, right? And one of the other areas where we're going to see a lot of attention is, what does it mean to place something in service? For instance, there's something we worked on with Arnie and Matt is, could putting a piece of content on iTunes for a day, a week, an hour constitute placing it in service to trigger the immediate deduction?
Yeah, and there's an interesting distinction, I think, between the definition of placed in service under 181 versus under the new bonus depreciation rules, which the IRS might port over the 181 rule in the regs, but under the 181 definition, it's the initial commercial release or broadcast, and it specifically carves out and removes from that any display at a film festival or anything like that, or a display to investors. Under the bonus depreciation rules, they didn't port over the word commercial. It just says initial release or broadcast, which I found interesting. I don't know if that has relevance because the IRS still is going to issue regs and they might port over the same definition. And I guess to Alan's point about YouTube, if you put it online and it has the ability to earn income, even if you're in the 181 definition, I think the commercial component, if you put it on a platform that could earn some income, that might qualify.
So we are not going to be able to address the numerous and massive changes to the international tax rules that are in this bill. That would be a whole separate presentation. But there are a couple of select changes that are relevant to the talent community. Mike, you want to run us through a few of these?
Yeah, just very briefly on the talent side, there is what you guys are probably familiar with, a transition tax or the one-time deemed repatriation tax that applies to U.S. residents that own interest in CFCs. And where this has come up in the entertainment context is oftentimes you have folks coming that are foreigners that have spent a lot of time in the U.S. that have tripped the substantial presence test or are sort of unaware that they are now treated as U.S. tax residents. And if that was the case in 2017, when the deemed repatriation tax, the transition tax, is applied, and again, that was a snapshot in time, this is not a recurring issue that you necessarily have to think about going forward. It's for 2017 only, but again, those returns may or may not have been filed yet, so something to think about. If you have, for example, a DJ that's in Los Angeles on a 2-year stint and is now a resident by virtue of a substantial presence test, but has many CFCs from basically being a foreigner that has a lot of different businesses, well, it's quite possible that the transition tax might apply to the accumulated earnings and profits in those CFCs.
And that's as of a specific date at the end of last year.
All right. And many of us have seen these situations where you have a non-U.S. citizen, somebody who is a star or a director in Europe or wherever their home country is, and they set up these cockamamie structures that work where they're from, right? And it usually involves leveraging the lower corporate tax rates. They don't pay anything out. They borrow money. And as soon as and there's a ton of earnings and profits in those companies, and as soon as they become U.S. residents, if they happen to have a structure like that in place as of the end of 2017, they're likely going to get swept up under the repatriation tax rules, just like all the big public companies were, which is really what they were intended to cover, but it picks up the little guys too.
Yeah, so what if you have a client that falls in that situation, what that might end up doing is putting increased pressure on treaty relief and making sure that you can run through the facts to support that, notwithstanding that this individual tripped the domestic rule for being a tax resident, that there is overarching treaty relief because based on his closer connections and the residency tiebreaker rules, that we're able to make an argument that no, he should be treated as a non-resident in 2017. But again, it'll put increased pressure on that if you have a client that falls into that situation.
And then on the outbound rules, the takeaway there is, pretty much that if you've got talent that is doing any outbound work that because of the removal of the state tax deduction, that means that if you're in a high tax state, you're going to have more ability to use foreign tax credits because your federal rate on your effective rate is going to be higher, and conversely, if you're in a no tax or low tax state, you're generally going to have more foreign tax credit carry forward.
So guys, we're running short on time. Here's what I'd like to do. We have a section in here on, I think it's called Major Considerations for Major Studios. I'm going to let our few major studio representatives here read these at their leisure. And what I'd like to do is fast forward to state tax considerations on page 30. So we all know that state income taxes are no longer deductible, a very painful point for those of us that live on the coast. So New York has some really interesting workarounds that I'd like You guys are probably familiar with these, but I want Michael to walk us through how these work.
Yeah, this is kind of new stuff. That the New York budget was just approved in April, and it contained two workarounds to help New York tax residents get the benefit of being able to deduct their state and local income taxes for federal tax purposes, which is now capped at $10,000. So there are two programs that were put in place in New York. Query whether or not this is going to fly with the IRS. In all likelihood, they'll be challenged, particularly the charitable contribution approach. But let's walk through them and think about them a little bit. The first is what's called the Employer Compensation Expense Program. And what this is, it's a voluntary payroll tax. So your employers could voluntarily pay an additional 5% tax to New York State on employee wages. And if they do that, then the employee gets a credit for basically 85% of the tax that's paid to New York. And so the thought being, okay, the employee is not going to be made any worse off. Basically, the employer is going to pay an expense on its behalf, so the after-tax results of the employee is going to be no different. Now, most people think that, well, I guess two things. One, compared to the charitable fund approach, this has a better chance of withstanding IRS scrutiny. But secondly, as a practical matter, they don't see a lot of companies trying to implement this and explaining to their employees why their take-home pay in the current year is less because they're going to get an offsetting tax benefit in the following year, and we're doing something to help you out. And the conventional wisdom is that not a lot of employers are going to do this. But let's think about that in the loan-out context, where the employer is the employee. And for the loan out to voluntarily pay an additional 5% and get that characterized as a payroll tax that is fully deductible at the federal level, and then the employee gets a basically equivalent credit for New York resident talent that have this issue. I mean, this might be a very easy solution to try. I'm not going to say it's an easy solution that will work, but it's an easy solution to try. And I don't know if it's kind of new, so it needs to be thought about a little bit, but for our purposes, it's something to think about. The second approach is probably more familiar to the folks in this audience, which is a state, New York State in this case, has set up a charitable fund that its residents can contribute to and get a credit for basically a percentage of the contributed to amount. So query why it wasn't 100% of the dollars contributed to these new two state charities. Well, the rationale there is that if it was set at 100% credit for the amount of the donation, that there would be a very clear quid pro quo. It'd be hard to argue that there was any donative intent if you're getting exactly equivalent value. So to have better facts, you'll notice that it is a large percentage of, not 100% of the amount of the charitable contribution. The Treasury has sort of commented in the press that they don't think that the charitable fund approach is, Mnuchin said, quote, ridiculous. And, so there's a lot of attention that's being paid to the charitable fund approach. There is not a lot of attention being paid to the first approach. And in the loan out context, the first approach may actually not be that hard to try. I guess a few other quick points to note for New York purposes. New York City does not respect or recognize S corporations. So if you have an S corp loan out, it's going to be taxed as a C corp for New York City purposes. And why this is relevant is because notwithstanding recent New York tax reform, getting rid of the income plus compensation tax base for general corporations, C corporations, New York City has not dispensed with that alternative formula for S corporations. So you do not want a talent working in New York City to be working through an S corp loan out, because if you bonus out the comp, it'll be brought right back in under this alternative formula.
And just to know that in our employment agreements, we have a carve-out that allows the talent to do direct engagements if they're working in New York City, with the goal there being of If they're working in New York City, they can engage directly and not go through their loan out to try to plan around this situation.
Yeah, so what do you do for the client making 200,000 episodes for 13 episodes in New York City? Not set them up as a C corporation? You're going to have them work as an individual and not be able to deduct, 40% of $2.6 million.
Yeah, I think
So you bonus out the compensation as a C corp, but if it's a C corp, it's not brought back under the alternative formula. If it's an S corp, that bonusing out as a salary deduction wouldn't be respected. So that's why Cs are better. You still see, yes, yeah, or direct work.
Say that one more time. This is news to me. So if it's an S corp, the deduction wouldn't be respected.
Well, there's the alternative formula of income plus compensation. Right.
Oh, yes. The New York City minimum tax would apply.
Right.
You still can deduct the compensation for federal.
Oh,
purposes,
for federal. This is a New York.
The New York City minimum tax.
Only. Right.
Yeah, and what we usually see is that the New York City minimum tax is not enough to warrant a direct engagement.
Okay.
Because if you go direct, you can't deduct any of your expenses. So is there a difference between S and C with respect to the minimum tax? Does the minimum tax only apply to?
They got rid of it with Cs. They did not get rid of it with S corporations.
Why? That makes no sense.
It makes no sense.
But they didn't change the S corp rules of that tax either. They didn't reduce the.
Right. That's right. Right. So the old regime still applies to S corporations, but there's this alternative was removed for C corporations.
So that would make sense then to have a C corp for a situation where there's meaningful money, like your fact pattern. Having a C corp loan up for New York purposes, stupid as it is, might make sense.
Right.
Okay. We have a few more minutes.
And I guess California has similar initiatives. They proposed recently forming this California Excellence Fund, which the intent is that you would be able to make a charitable donation to this fund and get an 85% tax credit applied against your state taxes, which really is intended to mitigate the repeal of the state tax deduction. And of note, there's already in existence a college access tax credit that's already available in California, but you have to apply for it, and the amount of money available in terms of the credit is limited. So if you have interest in this for any California clients, you should go through the application process, because I'm sure there's probably a lot of people trying to do it.
We're not highly confident about these approaches. Of all the things we've seen at the state level, the payroll tax approach that Michael mentioned seems to be the most defensible, relatively speaking. Okay, let's rip through the last couple of topics. Sexual harassment. Shane, not one of your specialties, but something you know a lot about from a tax perspective.
Yeah, so the takeaway here is that under the new law, if you have a non-disclosure agreement with any kind of claim that's related to sexual harassment or sexual abuse, the payor cannot deduct the settlement payment, and it can't deduct legal fees. So the cost of harassment settlements now effectively is a lot more.
But that's only if the plaintiff has to sign an NDA.
Correct.
There's an NDA and it actually wasn't sexual harassment, it was an accusation of it. And it turns out it was like maybe just somebody making up
You'd want
an NDA.
You'd want to
save your client.
listen. Carrie, bless you. So much of this, Carrie, depends on what's called the origin of the claim. Where did this claim come from? You would put in your settlement agreement, you would put all kinds of self-serving language about what this was about, and you would deny that it has anything to do with sexual harassment. But if there's 28 demand letters and emails and threat, then it's hard to get around.
Another claim where there's an NDA?
Yeah, if it's not related to sexual harassment, this NDA issue, there's no issue on the deductibility. It's only if it's a sexual harassment claim and the NDA is required.
And to give a real-life example, we represented a company that there was a claim, there was a sexual harassment claim, and there was a claim for royalties for certain software that was created when the employee was there. So in that case, the statute of limitations had expired with respect to the statute of limitation claim. So what we did was we allocated more to the royalty claim justifiably, because in my mind, the sexual harassment claim, if you can't bring an action in court, it doesn't have a lot of value. So that's what we did on the company side. And then we had the claimant come back and say, well, hold on a second, under the new law, I can't deduct miscellaneous itemized expenses, and we want to revisit this, and I'm not signing the agreement until we figure out my taxes. Because as a practical matter, if there's a $3 million settlement claim and 40% goes to the lawyer from the claimant, $3 million is included in your gross income. If the lawyer fees are deductible with respect to the claimant, the net recovery is $900,000 versus if you can't deduct it, then you're only getting about 10% of recovery if the legal fees are not deductible.
So the third bullet on this slide that Shane is pointing to will lead you to probably the single biggest loser coming out of the tax bill, which is the plaintiff's bar. The contingency plaintiff's bar, especially in the employment context, just had all of their fees become non-deductible. And I don't think that was an oversight.
Yeah, and in that particular case, how I got the claimant comfortable with signing the agreement is that under Section 62, that defines what above-the-line deductions are, and included in that enumerated list of what constitutes an above-the-line deduction, which by definition is not a miscellaneous itemized business expense, is both costs associated with claiming royalties as well as legal fees associated with sexual harassment claims. So I convinced them that you should be able to deduct the expense for the royalty as an above-the-line deduction. The issue with the above-the-line deduction for legal fees for the claimant is that Section 62 is a definitional section. It's not permissive, and you have to look to 162 or 212, which is trade or business expense of being an employee or expenses associated with trying to generate income. And the new statute that deals with NDAs is very broad, and it says any legal fees under this chapter, which would pick up, by definition, legal fees of the claimant. So that's going to be a issue, and people need to think about creative ways to potentially take a deduction if they can.
Okay, so
Stormy Daniels actually a good example there. It wasn't sexual harassment claims, it was a keep your mouth shut.
this,
Back to it.
yeah, the origin. Well, there was an attempt at some levity in our deck, but I couldn't help but notice that, to the extent there was a claim related to Stormy Daniels, that it was still deductible because it happened the year prior. And due to the one last point, the incidence of divorce in our universe is probably higher than elsewhere. So, Mike, can you just give us a quick?
Yeah, very quickly.
And then we're going to call
previous, before tax reform, alimony payments were deductible by the payor spouse and includable in income of the recipient. Now that's changed. There's no longer a deduction, and there's no longer an income inclusion on the other side.
So the arbitrage that we used to take advantage of is gone, and that one was probably good tax policy. But I did note, Michael, that in New York they're not conforming to that rule. So for state tax purposes, you can still take advantage of that.
Yeah, in New York, there's a lot of non-conformity with these changes to benefit New York state tax residents. So, for example, the ability to write off employee unreimbursed business expenses, you can still do that for New York tax purposes. And some of the other miscellaneous itemized deductions that hurt at the federal level are added back or decoupled from at the state level. So don't just assume that New York is going to follow all of this. There are still a lot of rumblings at the state level to distance oneself from it.
Well, it's 7:00, so we're gonna end our presentation right now. If you guys have any other questions, come see us afterwards. You've been a great audience. Most of you stayed awake for most of the presentation. And there are refreshments if you'd like to have another glass of wine before you hit the subway. Stay with us. We'll probably. How long are we going to be here? Another half hour? Hour? Yeah, as long as. Okay. No closing time.